Welcome to Investment Ideas. I'm your host, Ed Harris, and we're talking to Michael Kantrowitz of Cornerstone Macro. And we're going to talk about a theme that is ever recurring, and we're going to speak a lot to here at Real Vision in 2020. It is growth versus value. Michael, great to have you here.
Thanks for having me back.
You know, before we get into the actual topic, since you're new to Investment Ideas as a platform show, have you introduced yourself to the viewers and what you do at Cornerstone Macro and how your firm goes about investment?
Sure. So I'm the Chief Investment Strategist at Cornerstone Macro. We are a macro research shop. We provide research to institutional investors. We typically focus on about a 12 to 15 month time horizon in terms of our recommendations. We're trying to catch inflection points, major inflection points in the business cycle, and to help investors position their portfolios around those inflection points and those trends to profit from them. And so we have many teams at Cornerstone. I do portfolio strategy and quantitative research. We also have a team that does economic research on a global basis. We have a team in DC, an office in DC that focuses on central bank research, as well as DC legislative and things like trade tariff news, like what's been in the news recently. We also have a technical analysis team, an energy team, and so we do a lot from a macro perspective. And obviously, not only in the last decade, but even the last several months, macro just continues to heat up as a point of investment ideas.
And you know, we're going to be talking mostly about equities, I imagine, but do you cover like asset allocation outside of equities and so forth?
Yeah. Our team, we do everything from asset allocation at the top. So we help a lot of our clients are asset allocators, trying to figure out where to allocate money in a given year between growth or value, large or mid-cap, U.S. or international equities. Then we also do some work on fixed income as well, and all the way down to the stock level using quantitative research. And what's unique about our product, we think, is that our quantitative research very much blends together with our macro outlook. So we don't believe in a static world of how to pick stocks. It's very much a byproduct of what we see coming in the macro future, where the major trends, where interest rates going to go, where commodities going to go, and that has a big implications for which stocks you want to own.
So, you know, that leads into this whole growth versus value theme, because actually your secular view on growth versus value is kind of different than your 12 to 15 month horizon. And I want to talk about that first from the secular point of view, and then like drill down into what you're looking at over the next 12 to 15 months.
Sure. So about eight years ago now, we published a report, and the title was "Value Investing is Dead." And the idea was that, you know, for so many decades, especially beginning the early 1980s, value investing had done so well relative to growth investing. And a typical cycle is you would own value for several years, and then the economy would go into a slowdown. Sometimes that slowdown would turn into a recession. During that period of time, usually you wanted to own growth. And then as soon as the cycle rebounded and started again, you wanted to be back in value. And so we had the phrase that you wanted to live in value and vacation in growth. And ever since 2008, the worlds have been reversed. You've wanted to live in growth, in other words, have growth as your dominant core investment strategy, and from time to time, go back into value when appropriate.
Right. And so why is it that you see that transformation happening from vacation in one and living in the other to the reverse?
Sure. Well, a lot of the tailwinds that produced such a great backdrop for value investing, and this is going back, you know, you can argue going back 100 years, not only back to the beginning of the 80s. And so what were some of those trends that gave you a good backdrop for value investing? Certainly in the 80s and 90s, you had falling interest rates. From the 70s period where rates were skyrocketing, creating a lot of macroeconomic vulnerability and volatility. And so beginning in the 1980s, you had rates falling for basically, through today. We had consumers taking those declining interest rates and borrowing at a faster and faster pace in the 80s and in the 90s. In fact, in 1985, consumer credit growth had its sharpest one-year growth rate ever, growing at about 35%. And then 10 years later, in 1995, you saw consumers again borrow at a pace of 25%, looking at revolving credit. The last decade, the average has been about 3%.
Wow, yeah.
And so when you think about the benefit of lower interest rates and all that borrowing it created spending. And so what does spending do? It creates earnings for companies. And that earnings was then plowed back into more investment, more jobs, and it just became a circular positive feedback loop until it all imploded in 2007 and 2008. And the popping of that secular debt bubble, which we would argue was really drove an earnings bubble, which contributed to this period of value outperformance that was so sustainable and so safe, the way Wall Street viewed it. It all ended in 2007 as interest rates started falling after the Great Recession, and you saw not consumers borrow more, but actually start to borrow less. You saw the savings rate go up.
Right.
And so we've seen the benefits of lower interest rates begin to decay and ultimately lead to less growth. And so now we have an environment where global growth is somewhat weak at a much slower level, and that's giving us low inflation, low interest rates. And so a world of slower growth rewards those that are growing. And that's why growth investing over the last decade has done so well, because the number of companies globally, and even in the US, that can grow at 15, 20% annualized, the number of companies has just gone down dramatically. And so that's why today, I think the top 5 names in the S&P 500 make up 30% of the index almost, or a really large number. I would argue it's not because people are so euphoric on these names, like some stocks were priced in 1999, 2000. I think it's quite the opposite. The reason there's such a premium for these growth names that have really good businesses, making tons of cash flow, have plenty of cash on the balance sheet, real healthy companies, is because of everywhere else around the world, these typical classic value and cyclical companies are not doing very well. So because of the attrition of their growth, investors have flocked to where companies are growing. And so there's been a lot of tailwinds that are just gone. We had trade agreements throughout the 80s and 90s, and obviously now we've seen in the last 2 years, we're going the other way, having trade wars. We had massive amount of globalization, technology and innovation that took place, just-in-time inventories, all of these things that led to less macro volatility in the 80s, 90s, and 2000s. And that's a good backdrop for value. Now we have slower growth, more macro volatility, and so that's a world where growth or defense is going to work much better.
So now when you talk about growth versus value, what about sector analysis there? What are you talking about in terms of what kinds of companies, or could it be companies from very different sectors?
Well, you can have, you certainly, if you look in any sector, when you look, everything's relative. And so there's always a company that's going to be growing faster than its peers. So even you can look in utilities and find a growth company. Maybe even in energy, there's growth companies, even though the sector doesn't seem to grow very much nowadays. And so when we first think of growth and value, we think of it very much from a factor perspective. So we try to isolate out the macro, the sector exposures. In other words, we're not just talking about technology as a growth sector. We're talking about the characteristics of an individual company that are growing at a faster pace than their peers. So again, we look at it sector neutral. And growth investing hasn't just worked in technology. It's worked really well in the discretionary sector, but it's worked really well in the staples sector. It's worked well in the healthcare sector, in every sector, because again, it's not just technology that's growing. Investors are rewarding companies that are growing relative to their peers, irrespective of the sector.
Right. And so when you guys are looking at talking to asset allocators, how do you talk about that in the context of how they should allocate their assets across different sectors? Because obviously you could have outperformance. An example would be, I remember in the late 90s, early 2000s, there was a thing of independent refiners, and people who were leveraged to independent refiners wanted to get the ones who had the highest ability to process heavy crude and sour crude, because the margin differential was much bigger there. So you could say, yes, we want independent refiners, but then you could say within that space we want Valero or we want Tesoro, things of that nature.
Yeah, and then that's where our quantitative research comes in, where we drill down within let's say software, definitely a growth sector, but which names within software. So it's not only growth investors are paying for, but they're paying also for visible or sustained growth, where there's visibility. Companies that, for example, have 5 years of visibility where they have software subscriptions. So it's not only growth. In the 2000s, there was a lot of growth ideas, but it was really volatile. Growth numbers would be all over the place, whereas nowadays, what's being rewarded is not just companies that can grow, but can grow consistently and without macro volatility. And so, again, in a world today that's growing slower, where value and cyclical companies may have a good year here and there, but they're never going to catch up to a world of some of these growth companies that can grow 20% every year. Whereas in the 80s and 90s and 2000s, where value generally worked better than growth, value companies were growing earnings faster
Right.
for most of the cycle than growth companies. People tend to think growth is always growing faster. It's not always true. It's usually when the cycle slows that value companies' earnings start to decay, and then people pay up for growth. In this decade, in the last decade, where growth has dominated value, pretty much it's been sustained outperformance of earnings in growth stocks. Your value has only actually done well in a couple of years, 2009, 2013, and 2016. And unlike the 80s, the 90s, and 2000s, where it was really robust earnings that led cyclical and value names to do really well, the catalyst for outperformance and value in the last 10 years has actually more been about PE expansion and a decline in risks. And if you think about 2009, credit spreads at the beginning of that cycle were really, really wide. Mm-hmm. Same story in 2012, same story in 2016. And rule of thumb is that when credit spreads collapse, usually takes place during an economic recovery, the stocks that benefit from the most from that will see the most PE expansion are not growth names, they're not defensive names, they're value cyclical names. And so we're actually coming on a year, 2020, where we think we're going to see a little bit of that, which is going to lead value stocks to do better than growth. I don't think it's going to last more than 12 months.
Right.
But if we're looking for a period of value to work, this is as good as it's going to get.
Well, yeah, that was the transition I was going to make, actually, as you were saying, because that was the obvious next question about. I know that you are looking at value, but it's not a consistent play. It's only a tactical 12 to 15 month type of time horizon that you're talking about.
It's a cyclical play,
right?
And not only we're recommending value, but we're also recommending higher quality value. Mm-hmm. And part of that is because we're 11 years into this economic expansion now. So even while we begin to see better economic data in 2020, and this will be now the fourth mini cycle in this economic expansion, it's not going to be as strong as it was in 2009, 2012, or 16. In the US, we have full employment today. Mm-hmm. So you're not going to have people getting jobs, gaining jobs, like we had seen, obviously, in periods where the unemployment rate was 7%, 6%, 5%, 4%. We have record low unemployment rates, record low unemployment claims. And so pretty much everyone in America has a job. And so there's not going to be a lot of operating leverage, if you will, on the upside as things recover. So in other words, earnings growth is not going to be robust in 2020. It'll be better, and that's why you want to own some cyclicality and some value. But we want to steer away from companies that are broken, that are not profitable, because we don't think the recovery we're going to see in 2020 is going to be robust enough to lift all boats.
So you're in the recovery group, Cornerstone Macro. You see the recovery. Before we go into sort of the the reasons, what your portfolio is that you're recommending to clients, let's talk a little bit then about the macro background that will create that environment. What are you guys seeing for 2020?
Yeah, so 2020, I think the outlook is that we're going to see a cyclical upturn in leading economic indicators. We're already beginning to see some of that. Some of the housing data has been strong now for a couple quarters. We expect now the manufacturing data to tick up. So things like PMIs, the ISM index, the global PMI, that JP Morgan publishes, things like that, which have been declining for about 2 years now. We expect them to now start to bottom out and start to reaccelerate in 2020. Why is that going to happen? I think the answer is very simple. Why does it always happen? It's because you get a slowdown, and during a slowdown, the same thing typically takes place. Interest rates come down. Sometimes central banks cut rates. Input prices of business operations come down. We look at the prices paid index in the PMI surveys, which is a measure of the cost of doing business. And companies every month, everyone looks at the new orders component and they look at the PMI and what is it? Is it above 50? Is it below? Very rarely do people focus on this input price component, but it's actually the only forward-looking data point in all the ISM data. It has a ability to forecast the business cycle with about a 15-month lead. And again, it's measuring, are your costs of doing business going up or down? And we've found, in general, the business cycle reaccelerates after you've had a drop in business costs, whether it's input costs in general or interest rates or both, for about a year and a half, which is what we've had in 2019. Interest rates have come down. And now that's going to reinvigorate manufacturing activity, which will ultimately lead to better earnings and a broader economic pickup.
Well, let me interject because, on Real Vision, a lot of people that we've talked to have the story that they're telling is that, okay, yes, there may be a pickup there. Some of it's trade related in terms of the global manufacturing sector. But when you look at the PMIs, Asia and Europe are the places that are leading, and actually the United States is lagging. If you look at the ISM data for the United States, it's below 50, and in fact, forward-looking, exactly what you were talking about, the new orders component is even lower.
Yes.
So that would suggest, actually it could go down even more. What would you say to that?
Yeah. So we have a framework that we use to help us try to identify inflection points in the business cycle. And so I mentioned that changes in interest rates and changes in input costs, those lead things like new orders by about 15 to 18 months. Mm-hmm. And so that's a long lead time. And anything with an 18-month lead is not going to have a tracking error of 1 month. It's going to have a tracking error of 3 months. So there's a window of opportunity where the inflection point is going to take place. So we can improve upon that by seeing and asking ourselves, well, after rates decline, but before PMIs pick up, what are the things that happen in a business cycle that we should look out for to help us better understand or give us conviction whether or not this drop in interest rates is actually going to have a positive effect on PMIs 18 months down the line. And so when rates fall, they first usually start falling, the market rates start falling, so mortgage rates start falling. The Fed cut in July of 2019, last year. Well before they cut rates, mortgage rates were down 70, 80 basis points.
Right.
So housing started rebounding in the middle of 2019. And so why? Because rates were falling. From October of 2018 through right until the Fed cut, we had 6-7 months of falling mortgage rates. So every time, if you go back in history, the ISM goes back to 1948. Mm-hmm. If you looked at housing data, and so we look at the NHB, which is a housing confidence series, that goes back to 1985. Before then, you can use building starts, building permits. Every cycle, every one, not 9 out of 10, not 95%, but 100% of them, housing picks up before PMIs do. It's because interest rates decline first for mortgage rates, and you start to see housing begin to pick up first. And so has that happened in this cycle? Absolutely. The NHB index is sitting near 30-year highs. Housing starts have been shooting higher. And so that's a big part of our conviction is housing improving? If it is, well, that tells you that rates are going to continue to, in our opinion, flow through. The other things that also take place before PMIs pick up is money supply starts to reaccelerate. When the Fed changes policy rates, you see a pretty immediate being 6 to 9 months, but a pretty immediate response to how money supply grows, and specifically M1 growth. And so at the end of the Fed tightening cycle, the middle of 2019, M1 growth had fallen all the way down to about 2%. And if you go back in history, M1 only gets that low only after a tightening cycle.
Right.
And then the Fed stopped raising rates. They started cutting in the middle of last year. A few months later, we start to then see money supply pick up. So those all are people arguing that monetary policy is broken because rates are too low. I would agree that the multiplier is weaker today, but I would argue that monetary policy is clearly still working.
Right.
So money supply has picked up, and that's happened before every other ISM pickup. And then lastly, there's a ratio we look at that is a really short lead on the PMI, which is the ratio of new orders to inventories. Mm-hmm. So while new orders are sitting at a cycle low, we've seen inventories come down the last few months at a faster pace. And that typically precedes the headline index picking up. And so when last month we got that bad ISM print, for us, it didn't really throw us into any kind of tantrum or a period of uncertainty, because the things that precede an ISM pickup every cycle are all happening, which give us conviction that in Q1, which has been our call, PMIs broadly are going to bottom and start to pick up.
And by the way, the second part of that, and that was a great critique of that mantra, is that the United States is lagging. That is that if you really want to invest globally, we're talking about the U.S., but in the context of what you guys do from a global perspective, people are looking at ISM versus the market
Yeah.
PMIs.
Yeah.
What do you make of that?
Yeah, so we've been following PMIs for well over 15 years, and this year in particular is the first year I've ever seen so much focus on the difference between the ISM and the market PMI, and probably rightfully so because they are quite divergent right now.
Right.
And so the market PMI, they're different. They're apples and oranges. So, and understanding what the differences are is really important. So the market PMI surveys almost 900 companies as of the last data point. So they're out focusing on U.S. companies, 900 of them, and they're asking specifically, how are your U.S. business operations doing? And that's important because the ISM index surveys about 300 companies. They tend to be much bigger, more multinational, and they don't specify to asking respondents, only give me how your companies are doing in the U.S.
Right.
So companies are responding from how their companies, even though they're U.S. domiciled companies, they may have company exposure in China, manufacturing in Latin America, et cetera. And so they're giving much more of a global answer. And if you look around the world, Europe's PMIs, while they're starting to bottom out, are still lower than where they are in the U.S., as well as many other countries around the world. And so in a way, when you're looking at the ISM, you're getting more of a global flavor. It's not really, I would say, an accurate read on the U.S. economy, whereas the market PMI is a much better reflection of the U.S. domestic economy. And so the U.S. economy is doing better than the ISM. The ISM, though, again, is a reflection of the global backdrop, takes into account currency. When the dollar's been fairly strong over the last couple of years, that tends to more greatly hit the multinational companies or the ISM index. And so we think the ISM, though, is going to pick up for the reasons I just mentioned. But there are differences, and it is very much apples and oranges, and understanding what the differences are is really important. So we're not concerned that the ISM is sending us a U.S. recession signal whatsoever.
Right.
In fact, if anything, the ISM is overstating weakness globally, and it's probably the last man standing. And so we think that it will pick up. And why the U.S. is a little behind the rest of the world is because the U.S. did go through a tightening cycle up until December of 2018. We had a Fed rate hike. It wasn't that long ago, really. It's just over a year now. While the rest of the world, especially the developed economies, Europe and Japan, they weren't raising rates. And so they had, in a way, in the U.S. we had to digest that tightening cycle, whereas where other countries like Europe and Europe and Japan didn't have to digest the Fed raising the prime rate, pushing up credit card rates, HELOC rates, and things like that.
I think that leads perfectly into your 12 to 15 month outlook because, it would sound almost like you're saying that the U.S. growth will outperform, and from an asset allocation perspective, that's pro-U.S. Maybe you can kind of give a broad overview of, high quality versus high beta, U.S. versus Europe or Japan, and value versus growth in terms of what you guys are saying for 2020.
Yeah, so we think the U.S. economy, the U.S. is going to lead the global recovery. And so we think the days of China boosting and reflating the global economy are very much behind us. Secularly speaking, China peaked in 2011, where investment as a share of their economy peaked at about 48%, and that's been coming down and down and down. And now, cyclically speaking, while China's been doing very targeted stimulus, it's not the type of stimulus we saw in 2016 or 09 that massively reflated the global economy. And the data point we follow there is M1 growth in China, which is sitting at about 4.5% today. Coming into the 2016 recovery and coming into the 2009 recovery, money growth in China was up to 40% in 09 and 25% in 2016, coming into those recoveries, so preceding those recoveries. And money supply growth is a classic leading indicator, especially in emerging economies where the banking system is not as developed as in a developed economy. So in China, the fact that money growth has remained pretty weak compared to history suggests to us that they're going to be a stabilizing force, but not a reflating force in this global recovery of 2020. So with that, that gives us a better outlook, but not a booming outlook in terms of the magnitude of how much global growth is going to pick up. And so we think, given that, you want to focus on more high-quality cyclicals, The typical rising tide lifts all boats is not going to be very strong in this fourth global upturn now in the last 11 years. And so we're recommending a more cyclical bias. And actually in the US, the index has become very growthy, in the S&P 500 specifically.
Right.
In the last 11 years, the share of financials, industrials, materials, and energy has gone from about 46% in 2008. So maybe about 11, 12 years now, has dropped to all-time lows, and this data goes back 100 years, to about 29%, 46 to 29. And that's had a lot of implications, and it's obviously due to a slower global backdrop. Financials and energy, industrials, materials have been generally underperformers in the last 10 years. It's been, they've worked in pockets, but it's really been discretionary, healthcare at some points, and technology that have done really well over the last 10 years. And so the composition in the S&P has just now become so growthy that it's, one of the implications is that it's lifted the PE of the index. A lot of people look at the PEs of markets over time and say, I'm bearish because it's expensive, or I'm bullish because it's cheap. And so sometimes that works out, but valuation at a market level, at an index level, is not a very good timing tool. In fact, if you did a regression of any valuation metric, Case-Shiller PE, market cap to GDP, rule of 20, the Fed model, forward PE, trailing PE, any sideways PE, none of them have any forecastable power going out 12 months.
Right, interesting.
There's a zero regression, zero R squared, no relationship over 12 months, a big shotgun blast. So PEs is not, valuation is not a good market timing tool. And so when we look at the PE of the market today, you certainly pick up any newspaper and you hear about how the valuations have become so rich. And I think part of that's rightfully so. In other words, I think they're appropriately valued. And they could change if conditions change, but there's three things that determine the market, an indices PE.
Right, and let's go into that, but I just want to caveat this by saying that that in the comment section, people, all the people who are like the market is completely overvalued are going to be like,
I'm going to get, and hopefully I won't eat these words in a couple of months. So certainly most people believe, looking at the time series of valuation of the market, look, the market's only been more expensive than this in 2000, and obviously that didn't end well. But the market conditions have changed. The stocks that are expensive today are very different than those in the past. In 2000, those companies weren't making any money. Today, a lot of those companies are making tons of money. And so when you look at the valuation of the market, it's fair to say that it's expensive, but that doesn't necessarily mean it's overvalued. And for the example I like to give is a Porsche is an expensive vehicle, and no one would disagree with that. However, I would argue that it's probably worth every penny. Whereas a Pinto is a very inexpensive car, and you're not really sure is it going to get you to point A to point B. And that's the risk with equities here. You can buy something that's really cheap, but if it's cheap because it's got bad fundamentals, then is it really undervalued or is it properly valued? And so with the S&P 500, we talked about how index composition has driven the PE of the market up because there's so little cyclical exposure. In addition to that, rates today, let's say, for example, the 10-year bond yield is sitting at about 1.8. Or you can look at the BAA investment grade yield, which is sitting at about 4%, which is at basically all-time lows. So interest rates are low. And we all know lower rates in general, all else equal, give you a higher PE. But that's not the only thing that matters. It's also, I'd say that's the secular driver of PEs, as rates have been low for a long period of time, and they're not going sharply up anytime soon. Year to year, though, it's not really the level of rates that drive PEs. It's really credit spreads and risk. And so today we have a really unique environment in that rates are low on the 10-year bond yield, and at the same time credit spreads are very tight. BAA credit spreads are sitting at about 200 basis points right now. And so it's rare to get both very low rates and very low credit spreads. Usually you get a big growth slowdown, and then you get a financial market panic, and then you get low rates, but then credit spreads blow out. And then that's bad for PEs. Or vice versa, going back to periods in the 80s where PEs were much lower, you did have periods where credit spreads were even lower than where they are today, but you had much higher interest rates in the 80s. Today, we've got both low rates and low credit spreads.
And by the way, of those three, when you talk about the composition, when you talk about rates and you talk about spreads, it sounds to me like two are secular and one cyclical. That is the spread, is the cyclical one that could cause a compression in the PE ratio.
Absolutely. And the one that's overlooked, though, I would say, is composition. And I hear investors saying all the time, well, the S&P is the most expensive market around the world. Well, of course it is. What are the technology stocks that are growing like Facebook, Google, Amazon, and Netflix in Canada?
Right.
They don't have them. Or in other countries. And so
Europe.
the reason the NASDAQ is the most expensive market in the world because it has the best growth index. The growth, and the companies have the fastest and most stable growth around the world. If you look around the world and what's the cheapest index, it's Russia. Why? Because it's all energy and it's all super cyclical and super risky.
Well, talk to me a little bit about like the cyclicality and why. I think I saw a chart that you did showing cyclical PE ratios, and how cyclical you are definitely determines what your PE ratio is.
Yeah.
At a very basic level,
Yeah.
Why do you see the diminution of PE as the cyclicality of the company increases?
So in general, if the marketplace is fairly valued or efficient, riskier equities should have lower valuations. Mm-hmm. You should get paid to take risk as an investor, i.e. there should be a high risk premium. And so we've got sectors like financials or industrials, which are very cyclical. They'll do really well in a cyclical upturn, and they're going to underperform in a downturn. So something like that is going to have generally a lower PE compared to something like technology that's going to have less macro sensitivity,
right,
because it's got more of a secular, stable growth story. So just by the attrition of those four cyclical sectors, financials, industrials, energy, and materials, which pretty much all the time will have a lower PE than something like technology or even the discretionary sector, just because of the attrition of those names in the weights of those sectors have gone down, it's made all else equal the PE of the market go up. A lot of people overlook that from 2000 to 2007, the market got cheaper and cheaper and cheaper and cheaper. Then it blew up when it was trading at 14.5 times earnings.
Right.
Times earnings. It wasn't because it was expensive. It blew up because we had a massive debt collapse. But during 2000, from 2000 to 2007, the companies that were getting added to the S&P were financials, they were industrial companies, they were energy companies. They weren't tech companies, they weren't consumer companies like the growth company, like at Amazon today. They were very industrial, very old economy cyclicals, which made the market made it cheaper and cheaper. And so you mentioned the credit risk component, and that's the one that will make PEs go up or down in a given year. Index composition moves like a glacier, as do long-term interest rates. Credit spreads could pop any given day of the
Right.
week. And so the typical things that lead you to wider credit spreads, there's really four things when you think about it. It's things like an interest rate spike, like when the Fed's going to over-tighten, which we saw in 2018.
Right.
You can go back many periods. In fact, late in the tightening cycle, you often see PEs go down because investors are concerned that the Fed's going to over-tighten. We don't think that's a risk in 2020. I don't think anyone thinks the Fed's going to be raising rates. If they even do,
Right.
they're going to really become a headwind to the markets. We don't think they will raise rates. So that's number one, out, in our opinion. The second one is an energy spike, an oil spike. Shale has very much changed the game in the U.S. economy, made us much less susceptible to energy spikes in the U.S. Historically, you often got a Fed tightening cycle and an energy spike coinciding at the same time, which was always bad for PEs. And so we don't think an energy spike is likely in 2020, either from the demand side, because the global economy is just not going to be strong enough to produce a dramatic amount of demand for oil. And we've had two recent geopolitical events, the bombing of the oil field in Saudi Arabia, and then the killing of the number two in Iran, both touching the energy space, but even those have yet to really, those weren't strong enough to push oil prices
Right.
up. So so energy, I think, is a low risk and something that's going to pull PEs down. The third one, and most common, is a growth slowdown. Mm-hmm. And our
we talked
models,
about that, right.
we talked about our models point that we're basically exiting the growth slowdown now. To the extent that weaker growth would have hit PEs, that should have, could have, would have happened in 2019, and it really didn't. And so the fourth one is geopolitical events, which we can't forecast. It's Trump tweeting the trade war news. What if that goes wrong? What if something around the election starts to go wrong for the markets? And so these are things we can't really forecast or model, but are always a risk in any environment. And so that being the the always common risk to PEs, that's always going to be there. But the main three that you can forecast, high rates, spike in oil prices, or a sharp growth slowdown or recession, we think are not in the cards for 2020. So we think PEs can stay at these high levels for some time.
And to sort of wrap up, then you're constructive on risk assets. What kind of returns are you looking for, and what's your overall sort of allocation recommendation?
Yeah, so we're recommending a more cyclical tilt in 2020. Our favorite sectors are financials, industrials, and consumer discretionary. We like the consumer space because in the U.S. we have full employment, and we don't think we're going to see that income from consumers get chewed away from the Fed raising rates or oil spiking. So real income for consumers should look pretty good in 2020. So we like the consumer. We like industrials because we think PMIs are going to go up, and when PMIs go up, industrials outperform. And we like financials as well, and that's really a view that Europe is going to pick up alongside the U.S., and that's going to help to lift long-term bonds, steepen the yield curve, and that's really the developed economy story. So there's really two themes that run throughout our recommendations. One is developed over emerging markets, and that's because we think, yes, the U.S. and Europe will pick up, but the lack of money growth in China means that they're going to probably be more of a stabilizing factor as opposed to a really reflationary factor. The second theme of ours is high quality over high beta. And so again, we want to own cyclicality, we want to own value, but we want to be careful of sacrificing quality to do so. You don't want to reach today in the small cap 600, in the S&P 600 in the US, 23% of companies do not earn a profit today. Outside of recessions, the number's rarely that high.
Right.
And it's been rising for the last 10 years. And on top of that, not only do you have a quarter almost of the S&P 600 index not profitable, but for the first time in history, S&P companies in the small cap universe have more leverage, more debt to equity, higher ratios than they do in the large cap index. That line crossed for the first time ever back in 2018. So you have companies that are not profitable, that have big amounts of leverage, that are first in line for any of the wage pressure issues that we're going to have at some point in this tight employment backdrop in the U.S. economy. And so we don't think investors should be reaching deeply into small cap value, let's say, which is the highest beta size and style index of the 9 indices, large cap growth being one of the more defensive areas in the market. So we prefer larger mid cap value. And that for us gives us some exposure to cyclicality, but not overreaching and sacrificing quality in 2020.
Great. Well, Michael, it's been a pleasure to have you on Investment Ideas, and look forward to having you come back in the future.
My pleasure. Thank you.